All right, welcome. Let's get straight to it. We're going to build your personal trader's playbook. We're moving beyond just reacting to whatever the market throws at us and instead creating a systematic, planned approach. I mean, if you've ever felt like you're just guessing or throwing darts at a board, then you're in the right place.
But first, let's tackle the big question, the one that's always in the back of our minds. Why is it that so many people who get into trading end up losing? It's a huge question, right? Well, the answer is actually surprisingly simple, but it's the one hurdle most people just can't seem to clear.
It all boils down to this. They trade without a plan. They don't have a playbook. You know the feeling. They're reacting, not preparing. They're buying at the top because of FOMO and then panic selling at the bottom out of pure fear. But today we're going to flip that script. We are going to build the plan that turns that reaction into preparation.
Okay, so part one. This is where we start. The first skill we absolutely need to master is learning to see the end of a trend before it actually happens. This is all about spotting those early warning signs that a powerful trend is losing its juice and getting ready to turn around.
You've got to think of it like this. The market has its own body language. It's not a machine that just stops on a dime, slams on the brakes, and does a U-turn. No way. It gets tired, it slows down, and it leaves behind this trail of clues that tells you, hey, a change is coming. Our job is just to learn how to read those clues.
So let's break this down, because it's super important. Trends don't just suddenly die. They wear themselves out in these four pretty predictable stages. Okay, stage one, momentum reduction. You see the price is still climbing, but the jumps are getting smaller and smaller. Then comes stage two. It hits a wall. Like a flat ceiling, it just can't seem to break through. Stage three. This is the big one. This is the critical shift where it can't even make a new high anymore. And boom, stage four. That's the knockout punch. The old support level breaks and the reversal is on.
And look at this. This chart maps it out perfectly. I mean, you can see the whole story right here. Look at stage one. See how those upward moves are getting weaker? Then there's stage two, that flat top we talked about. Stage three is where you can feel the seller starting to take over. And finally, stage four. That's the definitive break. From that point on, every one of those previous swing lows becomes a potential target on the way down.
Okay, so spotting a potential reversal, that's step one. But how do we know if it's the real deal? Is it backed by the big guns, the institutional money? That's where we learn how to follow the money trail.
And this quote really says it all. At the end of the day, price moves for one reason. Money is flowing either in or out. If we can figure out where that serious capital is going, we can separate the real, sustainable trends from all the background market noise.
So how do we actually see this money trail? The metric you got to watch is turnover. Now, this isn't just about volume, which is the number of shares. No, this is about the total value of those shares. High turnover means big money is making big moves, and they're leaving behind a financial trail for us to follow.
Think of this table as your market X-ray. It tells you what's really going on under the surface. When price and volume are both rising together, that's the good stuff. That's accumulation. The big players are buying in. But what if the price is rising on falling volume? That's a huge red flag. It tells you the move is weak and probably won't last. And on the flip side, if the price is falling while volume is rising, that's aggressive selling, what we call distribution.
Now, the trick here is to separate the sharks from the minnows. When we talk about delivery, we mean shares that are actually being bought and held, not just day traded. See, a lot of people get tripped up here. They see a high percentage of delivery, but that doesn't mean much if the total volume is tiny. What you want to look for is a massive absolute number of shares being delivered. And here's the kicker. If you see that huge delivery number happening with a low number of trades, bingo, that's your institutional footprint. It means a few big players are buying in bulk, not thousands of small traders.
And the best part is, this isn't some abstract theory. You can literally do this yourself right now during market hours. Just pop open the stock screener in a platform like TradingView, find the column for turnover or value, and sort it from highest to lowest. And bam, instantly you'll see a list of stocks that are attracting the most capital. You're watching the money trail get laid down in real time.
All right, this next part is maybe the most important section of all. Before we even dream about profits, we have to become masters of defense. We have to know how not to lose money. And that's where your risk plan comes in.
And it all comes down to this one single number, 2%. If you remember nothing else, remember this number.
The rule itself couldn't be simpler, but it's everything. On any single trade, you absolutely cannot risk more than 2% of your total trading capital. This isn't just about math. It's about discipline. It's about survival. It ensures that a bad losing streak won't knock you out of the game so you can stick around long enough to catch the winners. This rule is totally non-negotiable.
Okay, so how do we actually put this into practice? It's just a simple formula, nothing scary. First, you calculate your max loss in actual dollars. That's just 2% of your capital. Then, you decide where your stop loss is going to be in terms of points. You just divide your max loss by your stop loss points, and there's your answer. That formula gives you the exact maximum number of shares you are allowed to buy. It turns risk management from a guessing game into simple math.
So where's the smart place to put that stop loss? Well, take a look at this. A really solid, low-risk spot is right below a little consolidation area. That's where the price was just chopping sideways right before a breakout. This area acts as a natural floor or support level. Placing your stop loss here is like setting a safety net. If the price falls back through the zone, you know the trade idea was wrong and you get out with a small, pre-planned loss.
Okay, we're in the home stretch. We've read the market, we've followed the money, and we've got our risk plan locked down. Now, let's put it all together. It's time to execute, and we're going to do it with a clean, automated strategy.
So here's the game plan, nice and simple. Your entry trigger, a clean breakout from a pattern. Your profit targets, just look to the left on the chart. Use those previous swing highs as your logical targets. And how do you manage the trade while it's winning? You trail your stop loss up to the most recent swing low. This is how you protect your profits while still letting the winner run.
Now, how do you do all this without being glued to your screen all day? The magic here is something called a GTT, or a good till triggered order. See, a regular order is dead by the end of the day. A GTT order, on the other hand, can stay active for up to a whole year. This means you can set your entry point, your profit target, and your stop loss all at the same time, then walk away. This is the real game changer. It automates your discipline and takes emotion out of the equation.
And here it is, the entire playbook, all on one checklist. This is what you run through before every single trade. Phase 1, find the setup by identifying those 4 stages of reversal. Phase 2, get confirmation by following the money trail. Look for that high turnover. Phase 3, plan your risk with the ironclad 2% rule. And Phase 4, execute it flawlessly with an automated GTT order.
So there you have it. That's the playbook. A complete system to stop reacting and start trading with a real, concrete plan. The playbook is right here. The real question is, are you ready to stop guessing and start planning?